Welcome to vTalkInsight, Market Drivers Daily for April 6th, 2026. Today, the oil shock around the Strait of Hormuz, an aggressive defense and AI spending cycle, and a renewed push higher in yields are colliding, creating a very different backdrop for equities, credit, and rates than even a few weeks ago. Middle East tensions and the status of the Strait of Hormuz remain the dominant macro swing factor, even as headline equity indices continue to look resilient. Shipping is no longer fully blocked, but transit volumes are still well below pre-conflict levels, with Iran allowing selective passage and even imposing tolls to retain leverage and sustain a premium in crude prices. This mix of partial relief and persistent risk is producing a tug-of-war between geopolitics and appetite for risk, with futures on the S&P, NASDAQ, and Russell trading higher on hopes for a possible 45-day ceasefire, while many cross-currents still point to the possibility that a larger energy shock is not yet fully reflected in asset prices. Behind the indices, the energy shock has clearly morphed into a broader supply chain event. Disruptions and selective closures in Hormuz are tightening crude and refined product balances, driving rapid inventory drawdowns and lifting gasoline and diesel prices worldwide, including in the United States despite ample local production. Damage to Gulf infrastructure, including major petrochemical facilities in Iran and Qatar, is now feeding into higher costs for chemicals, plastics, fertilizers, and even semiconductor inputs like sulfur and helium, while rerouted tankers and constrained air freight capacity between Asia, Europe, and the United States are pushing shipping and cargo costs sharply higher. At the same time, oil markets are showing unusual signals, with physical shortages and regional price spikes not fully mirrored in benchmark futures, and options markets displaying an inverted skew as call protection against price spikes trades at a rare premium to puts, underscoring persistent concern about upside oil risk. Security dynamics are also shifting capital and sector leadership. The proposed increase in United States defense spending toward roughly $1.5 trillion, alongside a separate $200 billion request focused on counter-drone and anti-missile systems, points to multi-year demand for both large defense primes and smaller, more innovative firms supplying autonomous drones, missiles, and AI-enabled systems, even if congressional resistance makes the final budget uncertain. Jefferies and others highlight names exposed to affordable, scalable drones as relative beneficiaries of this procurement pivot, while global defense stocks have already rallied on expectations of sustained munitions and drone capacity building. At the same time, long-standing arrangements like the petrodollar loop and the implicit trade of United States maritime security for dollar demand are under strain, even as the dollar itself has strengthened as a near-term safe haven. And equity leadership beneath the S&P index shows pain in materials and consumer sectors most exposed to higher energy and input costs. This leaves a debate over whether markets are underestimating the tail risk embedded in this conflict. On one side, current pricing and high-yield spreads, oil futures curves, and the modest drawdown of less than 4% in the S&P is consistent with the belief that the conflict stays contained, that oil supply losses are manageable, and that any risk premium in crude might settle in the order of $5 to $10 a barrel. Historical analysis that shows equities often bottom early in major wars, plus large wartime fiscal stimulus that can run to tens of billions of dollars per month, support the argument that much of the downside may already be in the price, and that growth support can offset some of the drag from higher gasoline and freight costs. The opposing view notes that up to 1/5 of global oil supply is at risk if escalation targets Gulf infrastructure or shipping, that Hormuz throughput remains fragile despite some ships passing safely, and that recent rhetoric and stalled negotiations leave considerable room for miscalculation, especially with United States stockpiles of key munitions already depleted and allies contemplating more independent naval operations. For multi-asset investors, the practical takeaway is that geopolitics is now a first-order driver of cross-asset dispersion rather than a background noise event. Energy producers, chemical complexes, shipping, airlines, fertilizer and food chains, and defense ecosystems are all being repriced through the lens of how long Hormuz remains contested and how far procurement and fiscal priorities ultimately shift. Key watch points are concrete metrics such as tanker and air freight capacity through the Gulf, evidence of further physical damage or repairs to regional energy infrastructure, the path of the United States defense budget through Congress, and any credible framework for a durable ceasefire rather than rolling deadline extensions. Those signals will also shape the next theme, because the same energy and security shocks that are driving this geopolitical premium are increasingly central to the inflation and rate story. Alongside geopolitics, the other dominant macro force is the AI investment wave, which is now clearly a real capital expenditure cycle rather than a speculative story. Jamie Dimon and other large bank leaders frame AI spending as a long-term productivity engine that can help offset slow labor force growth and cushion some of the drag from higher energy and freight costs, even as they highlight new risks around misinformation and cybersecurity. Recent data points reinforce that this is an infrastructure-heavy theme, with companies like Oracle committing tens of billions of dollars to data center build-outs and hardware partners, such as Foxconn, reporting quarterly sales surges of around 30% tied to AI-related equipment. On the hardware side, multiple signals point to an extended build-out. Analysts describe an emerging memory supercycle driven by accelerating enterprise demand in Asia, with shortages in memory and server components already visible and expected to intensify as AI deployment expands. Brokerage upgrades on storage and memory names, supported by improved pricing visibility and long-term demand expectations through 2027, sit alongside evidence from GitHub activity and large language model usage that inferencing workloads are growing rapidly. At the same time, innovations such as advanced memory compression are allowing major technology firms to push more AI workloads through existing infrastructure, supporting elevated gross margins for leading memory suppliers even as they navigate tight supply. Despite some isolated disruptions to data center projects in the Middle East due to security concerns, the broader global data center expansion and AI infrastructure demand remain robust, with only a small share of planned capacity directly affected so far. This AI build-out is driving clear dispersion within technology and broader equities. Institutional positioning has tilted towards semiconductors, hardware, and select energy plays tied to power demand, while optimism around AI continues to support specific companies rather than the entire tech complex. Software and software-as-a-service stocks, by contrast, are experiencing their most negative sentiment in about a decade, as investors question cash generation and the sensitivity of long-duration growth assumptions to higher discount rates. Even though entrenched platforms in areas like productivity software and enterprise systems are increasingly seen by some as undervalued relative to their role in AI adoption. Large platforms such as Microsoft are trading at the high end of their decade valuation ranges, yet forecasts for free cash flow growth in the mid to high teens over the next several years are cited as potential justification if AI adoption continues at pace. Capital markets remain open to this theme, with record corporate bond issuance, AI-linked initial public offerings, and even plans for very large equity deals, such as a potential SpaceX listing at a multi-trillion-dollar valuation, signaling strong risk appetite for perceived leaders in AI and space-enabled infrastructure. Security is emerging as another structural leg of the AI story. As AI expands the digital attack surface, forecasts now anticipate cybersecurity budgets rising from roughly 5% of information technology spent to about 10% over the next 2 to 3 years, implying strong growth runways for leading cybersecurity providers. On the kinetic side, recent conflicts have highlighted the strategic value of smaller, innovative defense technology firms that specialize in AI, drones, and counter-drone solutions, prompting a gradual shift in procurement, thinking away from purely traditional contractors toward more diversified vendor bases. Financial institutions, such as J.P. Morgan, are explicitly channeling capital toward United States military and technology initiatives framed around resilience, underlining how national security, AI, and capital allocation are increasingly intertwined. From a macro perspective, AI investment is functioning as both a growth cushion and a source of volatility. Strong AI-related capital, spending, and early productivity gains help explain why forecasters can still envisage around 2% United States growth this year, despite higher fuel costs and softer consumer affordability, and why corporate earnings estimates for out years like 2027 continue to drift higher. However, the same concentration of market enthusiasm in a relatively narrow set of AI beneficiaries, combined with already elevated index-level valuations near 19 times forward earnings, leaves risk assets sensitive to any disappointment on AI demand, new regulation, or further supply chain disruptions in critical components. Looking ahead, the key variables to monitor are corporate guidance on AI capital spending across both cloud and enterprise, evidence of easing or worsening component shortages, the pipeline of AI and defense-linked deals through bond and equity markets, and any material policy moves on cybersecurity and AI governance. Those developments will matter not only for sector leadership, but also for how well AI-driven productivity can offset the inflation pressures emerging from energy and supply chains, which brings us to the evolving inflation and rates picture. The inflation story is being reshaped by the same energy and logistics dynamics we have just discussed. Over recent months, Brent crude has climbed from around $60 to the region of $108, and prices remaining above $80 are already straining consumer affordability and corporate margins, particularly in energy-intensive and consumer-cyclical sectors. Rising gasoline prices above $4 per gallon in the United States, combined with higher diesel and jet fuel costs globally, are filtering through to freight, air travel, and ultimately goods and services prices, while disruptions in Hormuz and Gulf infrastructure are lifting input costs for fertilizers, chemicals, plastics, sulfur, and helium, with knock-on effects for agriculture and semiconductor manufacturing. Compared with a few days ago, when the focus was on the oil spike turning into a full supply chain shock, the narrative is now shifting toward how quickly these pressures will appear in official inflation data. Near term, markets are bracing for unusually strong inflation prints. Headline consumer price inflation is expected to register one of its largest monthly increases since mid-2022, with some forecasts looking for a rise around 1 to 1.5%, driven largely by a seasonally adjusted jump of roughly 20% in gasoline prices. Core personal consumption expenditures inflation for February is anticipated at about 0.4%, indicating underlying stickiness even before the full impact of the latest commodity and freight shocks. A 6-week disruption in Hormuz has already shown up in United States services prices, delivering the biggest increase in around 3.5 years. And business surveys are reporting a sharp rise in cost pressures across the services sector that could weigh on near-term growth. While some projections suggest headline inflation could approach 5% by April before easing later in the year, several strands of market commentary argue that investors remain too relaxed about the persistence of these pressures. Rate markets are starting to reflect this risk more clearly. The 10-year United States Treasury yield has already broken above a key resistance area around 4.2%. With technical analysis flagging the next significant level closer to 4.75% if inflation surprises keep coming. Yields are up roughly 15 basis points so far this year. Front-end rates have moved higher as rate cut expectations are pushed back, and the curve has flattened as longer maturities attract demand from investors concerned about growth, particularly given the drag from higher oil. At the same time, bond-equity correlation has turned sharply positive, reducing the effectiveness of government bonds as a portfolio hedge, just as valuations across many growth assets remain demanding, and treasuries have not served as the traditional safe haven in this conflict, with the dollar instead absorbing most of the flight to safety flows. Market pricing now embeds a higher for longer policy path with little expectation of imminent Federal Reserve cuts and some discussion of renewed hikes if inflation reaccelerates, raising the risk of a policy mistake if growth slows faster than expected. These dynamics revive stagflation concerns, but also leave room for softer landing scenarios. Persistent oil prices above $80, combined with rising shipping and input costs, threaten to push inflation expectations higher and squeeze real incomes, especially as job creation has slowed from the exceptionally strong pace seen in 2022, leaving households less able to absorb further energy shocks. Analysts note that rising fuel costs are likely to slow growth in the second and possibly third quarter, with particular pressure on consumer discretionary segments and on sectors such as chemicals, where recent rallies tied to higher oil have already prompted downgrades on the view that fundamentals do not justify current prices. Yet high-yield spreads remain contained. Corporate earnings forecasts and gross domestic product projections have not collapsed, and oil futures curves still imply a significant decline in prices by year-end, signaling that markets broadly expect this shock to fade rather than embed a permanent stagflation regime. Which of these paths dominates will depend heavily on upcoming consumer price index and personal consumption expenditures releases, further evidence from labor and spending data, and the tone of Federal Reserve communication around the possibility of additional rate hikes versus patience. 4. Cross-asset positioning. The message from today is that inflation risk is once again the central pivot for valuations. If energy and supply chain disruptions persist and long-term yields push toward the next resistance zone, the pressure is likely to be felt most acutely in longer duration assets, in the parts of technology reliant on distant cash flows, and in consumer sectors where higher fuel bills bite into discretionary spending. Conversely, a scenario where Hormuz disruptions ease, oil slides back from current levels, and inflation data rollover later in the year would validate current optimism around equities being able to tolerate moderate inflation as long as growth holds, particularly with AI-driven productivity in wartime and infrastructure spending still in play. In the meantime, watching how the 10-year yield behaves around its new range, how the middle of the oil futures curve evolves, and how closely inflation releases track the hotter expectations will be crucial for understanding whether the market is transitioning toward a higher for longer regime or can still sustain a softer landing narrative. That balance between geopolitics, AI-powered growth, and the inflation and rates path will remain the key driver set for the coming weeks. To wrap up, the Strait of Hormuz remains the fulcrum for energy, shipping, and defense spending, keeping a structural risk premium in oil even as equity indices hold up. At the same time, AI is evolving into a genuine multi-year capital expenditure cycle that supports growth and earnings, but also concentrates risk in a narrow group of beneficiaries and in stretched valuations. Overlaying both is an inflation backdrop that is re-accelerating in the near term, pushing Treasury yields through prior resistance and challenging the traditional role of bonds as a portfolio hedge. Watching Hormuz throughput, defense budget decisions, AI capital spending plans, and the next rounds of inflation data will be critical for understanding how this mix ultimately reprices equities, credit, and rates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.